AST SpaceMobile just reported 44% revenue growth year-over-year, reaching $54 million. But here is the number that actually reframes the story: $1.3 billion in contracted revenue commitments sitting in backlog, against a net loss of $74 million on a single quarter of revenue. The question is not whether demand exists. The question is whether they can deploy satellites fast enough to convert paper contracts into real cash before the burn catches up. This is AST SpaceMobile's first full year as a revenue-generating business. Full year 2025 revenue came in at $70.9 million, essentially built from zero, because the company had just $1.1 million in revenue as recently as the third quarter of 2024. By the third quarter of 2025, that figure had climbed to $14.7 million, and the most recent quarter printed at roughly $54 million annualized. Revenue is coming from two buckets: mobile network operator partners, 60+ signed globally covering 3 billion subscribers, and the US government. The backlog grew from $1.2 billion to $1.3 billion between Q1 and Q2 2026. That sequential increase matters because it means new commitments are arriving faster than old ones are being recognized as revenue. The Q2 2026 release shows operating margin at negative 136%, meaning the company spends $2.36 in operating costs for every dollar it brings in. Net loss was $74 million in the quarter. On the capital side, AST SpaceMobile launched a $1 billion convertible notes offering in July 2026, with an option for an additional $150 million maturing in 2034. That is not a distress signal on its own. It is the funding mechanism for the satellite factory. Bluebird 11 through Bluebird 33 are in advanced production. The target is 45 to 60 satellites in orbit by end of 2026. Peak data speeds hit 98.9 megabits per second over international waters using Block 1 hardware, which is a credible proof point on the technology. The causal chain is tight, and the sequencing is everything. More satellites in orbit unlock broader commercial service. Broader commercial service activates contracted revenue, turning the $1.3 billion backlog into recognized revenue. Recognized revenue improves operating leverage because the ground infrastructure and spectrum agreements are largely fixed costs. FCC authorization, already partially secured, gates the U.S. commercial rollout. Partners like Rakuten and STC Group are the conduits that connect satellite capacity to actual paying subscribers. Every launch delay pushes the leverage inflection point further out. The real risk is not competition from SpaceX or Amazon, it is execution sequencing. The 10Q filed August 10th flags that actual results could materially differ from estimates due to ongoing uncertainties. The company raised equity again via Class A common stock issuance while simultaneously issuing convertible notes. Dilution is compounding while the satellite schedule is still aspirational. If Bluebird deployments slip, the contracted revenue stays locked in backlog, the burn continues, and the next capital raise happens at a weaker negotiating position. The 52-week low sits at $53. The stock has already been cut nearly in half from its high of $133. AlphaOS surfaced the backlog progression from $1.2 to $1.3 billion across consecutive quarters, flagged the convertible notes filing as a financing event, identified the Rakuten and STC Group dependency edges, and pulled the operating margin deterioration, all from SEC filings and investor relations materials parsed automatically. The research did not require manual document hunting. Direct-to-device satellite connectivity is a real market, but the infrastructure race has specific choke points. SpaceX's Starlink direct-to-cell and Amazon's Project Kuiper are both scaling in parallel. AST SpaceMobile's structural edge is its existing MNO partnerships. 60 operators do not sign contracts speculatively. Rakuten in Japan and STC Group in the Middle East represent anchored revenue in markets where terrestrial coverage is genuinely incomplete. The U.S. government channel adds a second demand leg that is less price-sensitive. The FCC spectrum strategy, targeting roughly 100 MHz in the U.S. and 60+ MHz globally, is the moat if it holds. Regulatory slippage in any major market would compress the addressable backlog. 3 things to watch as this story develops. First, satellite cadence. Whether Bluebird deployments hit the 45 to 60 target by year-end 2026 is the single most important operational variable. Second, backlog conversion rate. If contracted revenue stays at $1.3 billion while recognized revenue grows, the thesis is intact. If the backlog stops growing, something is wrong upstream. Third, dilution pace. The convertible notes mature in 2034, but equity issuances flagged in the 10Q suggest the share count is moving. Watch that against revenue per share, not just top-line growth. The full research on AST SpaceMobile, filings, dependency graph, earnings intelligence is at alphaos.finance. Research and analysis only, not investment advice.